Every century or so, the banking system hits a breaking point. In 1907, panic swept through New York. In 1929, credit vanished overnight. In 2008, the global financial system nearly froze solid. Now, as we look towards 2025, the warning lights are flashing again. Deposits are shrinking, banks are quietly merging, and governments are rewriting the very rules of money itself. Is the world entering stage 5, the final phase of the modern banking cycle? Or can regulators stop history from repeating itself one more time? To understand what's happening today, we have to recognize the pattern. Economists like Charles Kindleberger and Hyman Minsky broke down every major banking crisis into a 5-stage process. First comes displacement, a major change like new technology, a war, or monetary reform creates fresh hopes for massive profits. Second is the credit boom. Banks start lending aggressively, leverage grows, and a wave of optimism spreads through the economy. Third is euphoria. Asset prices like stocks or real estate soar into the stratosphere, and regulators struggle to keep up. Fourth is distress. The first signs of trouble appear. Some borrowers start to default, credit tightens, and confidence begins to crack. And finally, stage 5, panic and reform. Bank runs begin, major institutions collapse, and the entire system is reset under a new set of rules. Every single time, the cycle follows the same emotional curve, from greed to confidence, and finally, to fear. Let's go back to 1907. At the time, the United States had no central bank. The system was a patchwork of national banks and less regulated state trust companies. Speculation in copper stocks went bad, causing a major institution, the Knickerbocker Trust Company, to fail. Panic erupted. Huge crowds lined up outside banks, desperate to withdraw their money. Within weeks, half of New York's trust companies had collapsed. It was the legendary banker J.P. Morgan himself who saved the day. He gathered the city's top bankers in his library and essentially forced them to pool their resources for a rescue. The panic eventually ended, but its legacy was profound. The near collapse convinced politicians that the country needed a lender of last resort. This led directly to the creation of the Federal Reserve System in 1913. Stage 5 had led to reform. The system almost died, and then it reinvented itself. Fast forward 2 decades to the Roaring '20s. Cheap credit, much of it supplied by the new Federal Reserve, fueled an unprecedented boom in stocks, property, and consumer spending. Everyone believed the good times would last forever. But when the stock market crashed in October 1929, the illusion shattered. The financial system crumbled. By 1933, over 9,000 banks in the U.S. had failed. With them, the nation's money supply shrank by a staggering 30%. This is what turned a regular recession into the Great Depression. In response, governments were forced to act. They introduced FDIC deposit insurance to restore faith in banking, passed the Glass-Steagall Act to separate commercial and investment banking, and eventually launched massive public spending programs like the New Deal. Once again, the pattern repeated: a boom, a spectacular crash, and a fundamental reform of the system. The cycle didn't stop there. The 1970s brought new challenges: oil shocks and runaway inflation. To survive, banks had to innovate. They created money market funds, rolled out credit cards on a mass scale, and expanded their lending globally. But deregulation during this period also introduced new risks. By the late 1980s, these risks came home to roost in the U.S. savings and loan crisis. Over 1,000 of these institutions failed, costing taxpayers an estimated $160 billion. The pattern was clear yet again. Innovation led to euphoria, which led to a crisis, which required a massive cleanup. And that brings us to the crisis many of us remember vividly: 2008. The early 2000s saw a flood of cheap money wash over the global economy, largely thanks to low interest rates set by central banks. In the US, housing prices doubled in just a few years. Wall Street banks took these mortgages, packaged them into complex derivatives called mortgage-backed securities, and sold them to investors all over the world, claiming they were perfectly safe. Leverage went to insane levels. At Lehman Brothers, for example, they had borrowed more than $30 for every $1 of their own capital. When homeowners started to default on their mortgages, the value of these securities plummeted. The entire system seized up. Banks stopped trusting each other, and credit froze. The impact was immediate and global. In just 1 year, world trade fell by 15%. To prevent a total collapse, governments and central banks stepped in with an estimated $29 trillion in liquidity support, bailouts, and guarantees. They slashed interest rates to near zero. And once again, Stage 5, panic, led to reform. New rules like the Dodd-Frank Act and Basel III were designed to make banks safer. A new era of monetary policy, defined by quantitative easing or QE, began. But the medicine used to cure the 2008 disease created a new one, a world completely addicted to low interest rates and easy money. This set the stage for the next cycle. The COVID-19 pandemic in 2020 triggered the fastest and largest monetary expansion in history. In just 3 years, central banks around the world effectively printed over $25 trillion. This tidal wave of cash sent asset prices into orbit. Stocks, crypto, housing, even fine art, everything exploded in value. It was the euphoria stage on steroids. But then came the consequence: inflation, the worst in 40 years. To fight it, central banks were forced to slam on the brakes. Interest rates jumped from 0 to over 5% in a matter of months, the sharpest and fastest tightening since the early 1980s. The whiplash was severe. By early 2023, regional banks in the US like Silicon Valley Bank and Signature Bank, which were loaded up on bonds whose value had crashed, failed spectacularly. This time, the bank run wasn't people lining up on the street. It was depositors pulling their money out with a few taps on their smartphones. The panic had gone digital, and it was faster than ever before. Which brings us to today, and the question of 2025. The pressure is building again. The symptoms are all too familiar. In the US, defaults on commercial real estate loans are soaring, with over $900 billion worth of debt flashing red. In Europe, banks are sitting on huge losses from government bonds they bought when yields were at rock bottom. Globally, household debt has hit an all-time high of $59 trillion. And central banks themselves are in a precarious position, holding assets equal to 60% of their country's GDP after years of money printing. We're seeing tight liquidity, falling confidence, and a quiet but momentous shift happening behind the scenes. The move away from traditional money towards central bank digital currencies, or CBDCs. This suggests that Stage 5 might not look like a dramatic crash this time. Sometimes, it's more like a controlled demolition. Old systems are allowed to fade away, while new digital ones are brought online to replace them. Governments and central banks argue that CBDCs will modernize payments, making them faster and cheaper. But critics warn they could open the door to unprecedented surveillance and government control over your money, including the ability to implement things like negative interest rates directly on your savings. Regardless of which side you're on, this is undeniably a reform phase, a transformation just as significant as the creation of the Fed in 1913 or the global response in 2008. In this new world, the role of private banks could shrink dramatically, while central banks become the direct providers of money to the public. History shows us a consistent trend. Every crisis expands the power of the state and the central banking system. We started with gold coins, moved to paper notes backed by governments, and we may be ending with programmable digital wallets controlled by central banks. From 1907 to 2025, the script has hardly changed, only the actors have. It always starts with excess credit and misplaced confidence, followed by a sudden panic, and ends with a political rescue that reshapes the financial world. If we truly are entering stage 5 of this great cycle, then a new monetary world is already being built around us. The real question is whether this new system will finally bring lasting stability, or if it's just the next illusion of safety before the entire cycle begins all over again. Thanks for watching. If you found this breakdown insightful, be sure to like this video and subscribe for more deep dives into the forces shaping our world. See you next time.